Hello, and welcome to the Cornerstone Wealth 2016 Mid-Year Update. I'm Jeff Carbone, Managing Partner. Today I'm joined with Brian Needleman, Chief Economist, and Chris Zaccarelli, Chief Investment Officer. Every year there are major themes to the market and the economy, and 2016 has been no different. Today we will discuss the Federal Reserve, oil, domestic and global growth concerns, as well as the most recent referendum in the UK to leave the European Union. Brian, could you recap the year to this point?
Sure, Jeff. 2016 started where 2015 left off. The Fed had just raised rates in December, causing the dollar to rise and equities to fall. Investors were concerned that the strong dollar would make it difficult for U.S. corporations to compete, causing revenues and profits to decline. This began an 11% drop in the S&P 500 by mid-February. At the same time, the price of oil had fallen from its peak of close to $150 a barrel to a low of almost $25 a barrel, bottoming the same day as the S&P 500. From mid-February until mid-June, oil moved up close to 100%. The Dow and the S&P moved into positive territory for the year.
Then, of course, the markets faced their next major challenge.
Yes, although there have been many. The next challenge, basically, is just when the markets started to stabilize, the UK voted to leave the European Union, causing a strong two-day sell-off because investors were on the wrong side of the decision, assuming the UK would stay. So at the end of the first half, most of the global stock markets were negative and bonds were positive.
What's your view on the remainder of the year?
I see housing, autos, and the consumer balance sheet strong. Meanwhile, business spending and corporate earnings growth is weak. My favorite area of the market during the beginning of the year sell-off was energy pipeline sector, which has done well. I still like them, while at this point I like oil refiners and European dividend stocks better. I expect GDP growth to accelerate and corporate revenues and earnings to begin to grow again. If this happens, you'll see global stock and high-yield bond prices high and make new highs really for the end of the year.
How do you see things, Chris?
Well, right now we're at a crossroads. For the past year and a half, the Federal Reserve in the U.S. has wanted to raise rates, but the rest of the world has continued to ease, and the volatility we saw earlier this year is a symptom of that tug of war. Now with the UK voting to leave the European Union, we've yet another headwind to global growth, along with continued uncertainty, and it's preventing the Fed from raising rates in the short term. In the meantime, the U.S. economy continues to recover from the Great Recession. Unemployment is back to pre-recession levels, and GDP growth remains positive. But the recovery's been uneven.
A main theme of 2016 has been around domestic and global growth rates. What is your take?
Well, GDP growth has been subpar, between 1% to 2% annually, despite the fact that we've been out of recession for 7 years. The slow GDP growth in the U.S. and around the world has allowed central banks to keep interest rates low without sparking much inflation. This can't continue forever, but clearly it's taking a lot longer than almost anyone imagined. As Brian mentioned, if we can get earnings growth and continued economic improvement, then stock prices can go higher. But if the economy starts to grow too quickly, then the Fed will want to continue raising rates, which would put us right back to where we started in the second half of last year. The problem we had last year was the anticipation of rate hikes, which can lead to the dollar strengthening, which in turn is a headwind for all of our multinational corporations and can be a shock to the U.S. economy.
So how has the Cornerstone investment team responded to this environment?
Well, the best thing to do in this situation is to have a well-diversified portfolio, broad exposure to stocks and bonds, both small and large companies, domestic and international, corporate bonds, treasuries, and mortgage-backed securities. As the economy and corporate profits expand, stocks should continue to move higher. But if growth stays lower for longer or we experience any additional shocks to the economy, then bonds should provide ballast to the portfolio. The United States has the best economy in the developed world, which is why we have most of our investments there. But as the European Central Bank and the Bank of Japan continue to do quantitative easing, that should make those parts of the world more attractive. Likewise, India and other emerging markets show great potential and should have higher growth rates than the developed world. Once we get past the issues that a sharply stronger dollar poses for the rest of the world, there should be opportunity to increase emerging markets exposure on a selective basis.
Chris, share your thoughts on value stocks, growth stocks, and asset allocation.
Sure. Value versus growth has been a large theme for 2016. It's the idea that dividend-paying, lower growth stocks would outperform the higher growth stocks, and I expect that to continue, but in a more nuanced way. Investors are going to need to be more selective, at least buying specific sectors such as consumer staples and healthcare, but more importantly, buying specific companies within the food products industry or the healthcare equipment and supplies industry. You need to identify companies with lower price-to-earnings ratios and better growth rates than are found in the utility sector, for instance. Asset allocation and diversification are more important than ever now, and given the effects of globalization and central bank policies, The 5-year period starting last year will most likely see increased volatility and many more market pullbacks than we saw during the previous 5-year period after the Great Recession ended.
Brian, a major theme for the remainder of this year will certainly be around the upcoming election in November. What are some of your investment thoughts?
Certainly, Jeff, because it's the main theme right now you're seeing on the news every night. You have establishment candidate, which would tell you that we're going to keep the policies about the same, and so the investments would be similar. But then you have another candidate that wants to change the way that the economy is running and overweight certain areas, so we would have to make more changes to warrant that and take advantage of the change. And that's the way we manage portfolios in any situation.
Thank you for listening, and thanks to our clients for allowing Cornerstone to work for you. As you can see, the world is changing at a seemingly quicker and quicker pace. And that's why we actively manage your portfolios both to reduce risk and seek out attractive opportunities for you. Thank you.